Welcome to this explainer. If you are an accounting student, or honestly, even a seasoned professional, you have probably felt that deeply familiar frustration at some point in your journey. You know the feeling, sitting in front of a heavy textbook, being forced to memorize dry, seemingly arbitrary rules. It can totally feel like you're just learning this disconnected language of debits and credits without any real context. But today, we are going to completely flip that perspective. Let's start right here with a really fundamental question. Why exactly is capital a credit balance? I mean, it's literally one of the very first things you learn in Accounting 101. But if you actually stop and ask most teachers why this is the case, they will probably just shrug and tell you, because that's the rule, just memorize it. They treat it like a law of gravity that simply exists without any deeper explanation.
And then, what about this second question? Why do drawings reduce capital? Again, it just feels like another arbitrary-seeming rule on a massive laundry list of things to remember before your next exam. But I really want you to think about these questions, because understanding the actual why behind them is going to fully hook your curiosity. It'll completely change the way you see your daily ledgers.
Okay, let's dive into this. The reality is that the answer to these core questions is not a modern textbook rule at all. No way. It is actually a 600-year-old secret. These rules weren't invented in some sterile corporate boardroom or by a standardized testing committee. They were forged during one of the most fascinating, volatile periods in human history.
The answer was born nearly 600 years ago inside one of the most powerful banking families in history, the Medici family of Florence. To truly understand your textbook today, we have to travel back to the candlelit ledger books and cobblestone streets of Renaissance Florence. This single banking dynasty absolutely revolutionized the financial rules we are still using right now.
The Renaissance wallet problem.
Imagine the scene. It's 15th century Italy. Global trade is exploding, and Florence is effectively the financial capital of Europe. But there was a massive foundational problem threatening to tear the whole system down. Think about the stark contrast and how money was used back then. On one side, you had extreme personal family spending, luxury silk clothes, extravagant royal weddings, buying political influence. And on the other side, you had the actual business money, merchant wealth, and operational banking funds. Back then, there was absolutely zero separation between the two. If a merchant needed money for a luxury purchase, they simply reached in and grabbed it straight from the business coffers.
And the result of that chaotic system? Constant business collapse. Because there was no line drawn between luxury personal spending and operational business capital, these merchants had no idea if their actual trade operations were even profitable. They were literally bleeding their own companies dry to fund their lavish lifestyles. It was an incredibly dangerous, unstable way to run global commerce.
The Medici paradigm shift.
Enter the visionary Giovanni de Medici. His family recognized that this current system was totally doomed. So they introduced a revolutionary mindset, the business entity concept. They declared once and for all that the business is completely separate from the owner. Accounting-wise, for the first time in history, the business was treated like its own person with its own entirely separate pockets.
Birth of the capital account. So let's break down how this logically builds into the exact rules you study today. Step 1. The owner invests their own money. Step 2. Because of that Medici concept, the business immediately becomes a separate entity. Step 3. Accounting now views this as the business effectively borrowing money from the owner. The business owes that money back. And Step 4. Because liabilities and owner claims naturally increase on the credit side, that specific claim is recorded as a credit.
Bad owner's claim, the money the newly separate business entity owes back to the person who funded it, is exactly what we call capital. That is precisely why capital became a credit balance and why it remains a credit balance in your textbooks today. It's not just a random rule concocted by an accounting professor, it's a historical record of a business owing its founder.
Drawings and personal spending.
Now, even with the business successfully separated, the Medici family obviously still needed money for their personal luxuries and political spending, right? But if they just logged those personal withdrawals as regular business expenses, they'd run right back into the same old problem. Distorted business performance. Mixing personal withdrawals with actual operational costs meant the true underlying profitability of the bank would become completely hidden. To solve this dilemma, the accountants created a brilliant protective shield: drawings. Drawings were created as a separate mechanism entirely, just to track personal withdrawals. Instead of carelessly throwing them in with the expenses of running the bank, they functioned strictly as reductions of the owner's claim on the business.
I really want to emphasize this clearly because it is an absolutely crucial takeaway for any accounting student. Drawings are not business expenses. Never ever. They are a direct reduction of the owner's capital stake. When an owner takes money out for a lavish personal dinner or a new suit, they are simply reducing the amount the business owes them. They are drawing down their claim, which keeps the business's actual operational performance completely pure and untouched on the ledger.
Legacy of financial discipline.
These mechanical ledger rules, they were about so much more than just balancing books. They were the true beginning of global financial discipline. And just look at the modern echoes. We see this Medici legacy literally everywhere today. When modern tech startup founders take salaries separately, or when major Fortune 500 corporations maintain shareholder equity or track dividends distinctly, they are following the exact same accounting principles born centuries ago in Florence.
Accounting didn't just organize money, it separated identity from ownership. That right there is the true triumph of the accounting profession. By successfully separating the merchant from the merchant's money, it allowed businesses to outlive their founders, to scale across borders, and ultimately to build the modern economy as we know it.
So I'll leave you with this final thought to chew on. Next time you sit down with your textbook or boot up your accounting software and you mechanically write out capital account or drawings account, will you remember the bankers who changed global commerce forever? Because you are definitely not just memorizing dry rules for an exam. You are actively continuing a revolutionary financial system built hundreds of years ago. Keep that epic history in mind, and those boring debits and credits will suddenly make perfect sense. Thanks so much for joining me on this explainer.